Good guys, bro. Welcome to a new video, man. Before we start the video, if you guys wouldn't mind like, commenting, and subscribing. A lot of people watching videos don't subscribe. Please subscribe. You know what I'm saying? And we're finna get into it. So today the topic is liquidity, right? Yeah, you can see 2K in the background, you know what I'm saying? I had to take me a little break. So I came over here and make this video right quick. Let's see. So today we're gonna talk about liquidity and what liquidity is. So basically liquidity, everyone has their own thing, philosophy of what's driving the market, right? Some people think buying and selling pressure drives the market. Some people think in fluctuation of orders drives the market. Whereas most people, most smart money traders, which is what we are, some of us are, believe that liquidity drives the market. And it's supported in the method that I trade. If you don't know the method I'm talking about, watch the last video of what I do on a daily basis after a liquidation, then I trade, trade that direction. That's based on liquidity, right? And what really is liquidity? Liquidity is basically like, you know how a car has gasoline. It's the gasoline of the market. It's what pushes the market up and down, and which pushes the market to take out certain targets and certain price legs. You know what I'm saying? So let me demonstrate, right? So we have liquidity on all time frames, right? All different time frames have liquidity. So you have the liquidity daily, the weekly, monthly, 4 hour, right? So what you want to do is just like in the last video, I was talking one of my previous videos, so I was talking about market structure. Everything is time frame based. So the liquidity above here is more important than the liquidity on the lower time frames. So as you see, what's going on, right? So let's talk about this. So we have the liquidity being swept here. So here we've taken out buy side. Since we're taking out buy side, what are we anticipating to do next? We're looking to take out sell side, which we do here. Now what? Even though we're taking out buy side and sell side, the market's not going back and forth, back and forth, back and forth. It's going up, down, up, down, up, down. You see what I'm saying? It's still making higher highs and higher lows. It's just taking out liquidity, the liquidity along the way. You know what I'm saying? So we're taking out buy side, we took out sell side, what happened next? Took out buy side, came back down, took out sell side, took out buy side, and what? Came back down, took out sell side. And this is the basic overall demonstration of a downtrend, right? So you have a downtrend, or also taking out buy side liquidity, sweeping the buy side and gaining momentum to go down and take out the sell side. What happens? We go back up, grab more momentum, more fuel to take out the next sell side. And we do the same thing, this little liquidation. And keep in mind, these are daily candles, so on the lower time frames, this looks a lot different. So look, took out liquidity, buy side, come down, take out sell side. Then what happens? The trend reverses. Now, there's a difference between liquidations and market structure shifts, and I'm gonna make a video separately on that. I'm trying to keep everything in a separate little entity and video so you guys don't get overloaded in one video, right? So, but basically, I'm gonna give you little hints along the line. So, basically, this is a liquidation because it's a wick. If it was a break of structure, it would be like a full momentum momentum having candle. You see what I'm saying? See this momentum having candle? See, this is a liquidation. It's not a market straight shift because we took this out, but there's no candle close. It's just a wick, meaning we've liquidated this area. Not a full market structure shift to here. This is a market structure shift. Okay, that's the basic premise of it. I'm gonna talk about it more in another video, They give better examples, but yeah, that's the basic principle, right? So what happened here? So look, now we've taken sell side, we gather some orders here. What happened? Took out buy side, took out sell side, took out buy side, took out sell side. These are this is just on the lower time frame, but we're still taking out sell side. So I'm saying take out buy side, take out sell side, take out buy side, take out sell side. You see what I'm saying? So y'all kind of get it. I'll mark it out a little bit. Sell side, buy side. What happened again? Oh my bad. P. Sell side, buy side, sell side, buy side. Still going up. And then the market of course reversed. See how this wick. Why the market didn't just go down? Because it had this wick. Strict break structure. Fair value got left behind. Entry, boom. Something. Yeah, that's the basic principle of the market. This is what drives the market. So the market comes up, takes out orders. Market comes down, takes out orders. Now, I know you're probably like, okay, so how do you know like which high and low should I really be paying attention to? Which highs and lows are really important? You know what I'm saying? So when you have an analysis, like let's take this chart for example, right? You have an analysis. You need to know where the liquidity resides. So basically, we're on a higher time frame chart. We're on a daily. So we're not going to be really, we're day traders. We look daily, right? So we're not really looking for, okay, we're going to take this out in a few weeks. You know what I'm saying? We're not really doing that because that's swing trading slash positional trading. We're not doing it. We're day traders. We trade every day. So let's analyze this. What happened here? We had these relative equal lows. They're not exactly equal, but they're relatively equal. And what happened? We swept them, and then what happened? We took out sell side. So now what are we doing? Taking out buy side. Now, do we expect price to come all the way back down here and take this out? We don't know. That's not very likely that price will do that. You know why? Because this isn't only a liquidation. This is also a market structure shift as well as a liquidation. So price, in my opinion, for what I'm thinking, will continue to go up. But do we have confirmation of that? We don't yet. See what I'm saying? But we know based on liquidity where the market we can use liquidity to pinpoint exactly where the market's gonna go. So we have market structure along with liquidity. So we took this out, and now we're looking to see if if and where price is gonna go. So we take this out down here. Sell side, take out buy side. But we also had a market structure shift. So we can anticipate price to possibly do this based off market structure. Now, what could it take out in here? It could come, sweep this liquidity, and then keep going. Let's go to a lot of time frame and see. Now, what liquidity do we have? We have a bunch of liquidity that could be potential for the market to take out. So this, and we can see that we're bearish here because look, we have structure. Structure. So now we know we're bearish for the short time being because we know overall we're bullish, right? So we're looking for an area that price could possibly come to go back up. So what's price gonna do? We just went up, took all these lows. So now we're gonna come back down and take some of these highs. Now do we think we're gonna take all these this high all the way out? This low all the way out? No, that's too far. That means we're gonna come back down and break structure. Just because it's not likely though doesn't mean it can't happen. Right? That's a possibility of what could happen. That's just blending market structure with liquidity. That's basically what it is, right? Now let's talk about. I want to go through how to find liquidity. Liquidity usually rests above and below equal highs, equal lows, and relative equal highs and relative equal lows. Liquidity was designed by the banks, the higher up traders, etc., the ones that are against the retail traders, in order to liquidate us and take our money out of the market. Because when you trade, you're trading. Sometimes they match your order up against somebody. So if you win a buy and they lose the sell, you make the money. You see what I'm saying? So sometimes they put the orders against each other. Sometimes your orders are just in the free market, right? What will Now when it comes to retail, what is this known as? This is known as support and resistance, right? So you have a support line. In retail, this is known as what? Resistance. So support, you have resistance. Now what is price doing? Price is wicking through it to take out buyers and sellers on both sides of the market. Some people say, okay, this is a form of resistance. So they say 1, 2, and they teach you that the third bounce is usually when you get in, because you gotta make sure it's like support and resistance, right? One bounce, two bounce. The third bounce is what retail traders have. They have their trade set like that at the line, like that, and they're targeting the high because they believe in higher highs, higher lows. Now this trade, all of y'all, now this is why some people win trades. They get the direction right, but they get stopped out. They use support and resistance. See, they have this. Okay, we're gonna buy here. Boom, get stopped out because the banks and the higher up traders and the people with all the money know that people trade using only support and resistance. Now, does it always not work? No. Some things work sometimes because liquidity aligns with support and resistance every now and then, as you see here. If they were to do it here, okay, prices can bounce this off the proper, boom. Like, see this one, they would have won, right? So it doesn't always work, but it doesn't always also not work. You see what I'm saying? That's the point of resistance based off of what retail traders do. We don't look at the market like that. We use the retail logic and we trade against it. That's what we do. That's what the smart money traders do, like I said, right? So if I'm looking for a buy, say for instance I'm taking this buy here, right? What would be my target? It could be these highs. What are these highs? Those highs are what? Relatively equal. Now let's go down to 1 hour. We got these relatively equal highs. We got these relatively equal highs. What happens? Price goes right through it. See? That's typically how it works. And that's how you find liquidity. Now, where else will you find liquidity other than relative equal highs and lows? So, liquidity rests under every high, and liquidity rests above every high and under every low. So, under here's liquidity in orders. Under here's liquidity in orders. What's going on? Has come down and taken that out in order to go back up and take out this. See, that's not just in this area. What does it do here? You see how it barely goes above the light? There's no candles. There's no candlestick that closes up here above this wick, above this high. There's no candlestick that closes above this high. The candlestick closes in sync with the high and wicks through it, which signifies that this theory works, which is what? Liquidity. A liquidation. This high just got liquidated in order to gain momentum to push price back down. And that's kind of like the premise of how liquidity works. It works on every pair and it happens on every pair every single day. I'm gonna delete. All right, there we go. Same thing here. Look, what are these relative equal highs? I mean relative equal lows. This price like wastes it, liquidates this. This is still intact because we're still making higher highs and higher lows. So this is going to stay intact. But we're taking this out to get fuel in order to drive the market up to continue our bullish play. Now, why is this high staying same? Right? We're going to go back over market structure. Right? Liquidity works something like this. This is somewhat of how liquidity works, right? You have a higher high, higher low. Now, what this low is considered a protected low. We have protected highs. Well, we have protected lows. So what's going on? Price is continuously bullish, right? So price is continuously trying to take out highs. As you see, this high gets liquidated. This high gets liquidated. This high gets liquidated. So all of these highs are getting liquidated. What's going on with these lows? It's protected. It's protected. So each of these lows are protected. So when the trend changes, what is price going to do? This is I just gave y'all a clue as to how you can create your targets. So what's your stop loss? If we know that this high is protected, and we're taking out and we're bullish, we can put our stop loss below this and put our take profit below this high. Now what happened here? Now what happens when the market shifts and changes in trend? Like it did. So now we have a market shift, market structure break, right? And shift. And this low is no longer protected. So when this is no longer protected, what happens? These are up for grabs, meaning you could very well come down and use these as targets. That's how it works, man. Everything's a system. All of trading is basically a system. You have an uptrend. When the uptrend gets broken, a lot of people look for this little pattern right here. Break. They enter here and they target these previously protected lows. Now what happens when the uptrend? Now these are protected, right? Now this is a protected high. This high is protected, and these highs are protected. Now these are no longer protected, and these are protected, right? Then what happens? Break a structure. Then what? Target this high, and then what? What did we just take out? Relative equal highs. See what I'm saying? And what are these? Relatively equal lows. Break structure. We took out these relatively equal lows. Took out this low, last liquidation, break structure. And what then we get into here after this break? What we looking to take out? Relative equal highs, as well as the previously protected highs along the way. That's what happens. Price takes it out. Right? And that's basically how liquidity works. It's very simple. It's just the thing that fuels the market. If you're in an uptrend, you're looking to take out buy side. If you're in a downtrend, you're looking to take out sell side. And you can see that very well here. Let's see. Now, what pair was that? Was it AU? That was AU, right? I like AU's example. AU? Let's look at G. I want it to be clean. I want y'all to have some cleanliness. That was AU. My bad. My bad, y'all. Yeah, I was on a 1 hour. Okay. So what's going on here? Let's mark out structure. So what? So this is our downtrend, right? So what's going on? Protect it, protect it, protect it. And this is protected. So the moment we see one of these protected lower highs get taken out with momentum, then what? We're in the uptrend, as we clearly see. So here, market structure shift, break a structure, right? And then what? We start making protected lower highs. This thing is liquidated, get more fuel. But as long as we don't go past this one, we're good. Because this one's been established. Established, established, somewhat established. Price goes take down, takes this out. Doesn't mean we're bearish yet. Why? Because there's no momentum pushing it down here. It's a wick. And that's what I'm talking about. It's not a break structure. It's a wick. What happens? This is the protected look. So you got protected, taken out, protected, taken out, protected. This is the protected because it liquidated. This protected. Mm-hmm. Just keep going up, making more protected highs and lows until, you know what I'm saying? Protected, protected. Until this is taken out, we're still protected. Or we want to be weary that we could still be protected, right? Happens. Now we're seeing bullish structure. Boom, we're bearish here. Come back down. See what I'm saying? You see, it's the same premise. So what happens? It took out all these protected highs, liquidated. Now it's going to take out all these protected lows all the way. It's going to take out most of these. Probably not all of them, but most of them. It's probably going to take all this out, come into this area, and then take off. That's just my synopsis. What I think could and would possibly happen, right? Let me show you guys in the trade example. I have a trade example. I do. Good. So pairing that with my other lesson while I was, if you haven't looked, go look at my AUD USD trade study. Right? I explained and broke down this whole trade right here. What was that? So did it date Thursday. Last Thursday. All right, cool, 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 cool. So look. So aligning everything that I've kind of pretty much talked about in this channel. Structure. Here's structure. So what? You have a break of structure, leaving behind a gap. I'll make a video on gaps, leaving behind this area, right? Price come back to, comes back down. So I have my stop loss. I know I want this is a wick, and this is only caused because of the news. So I'm not really paying attention to it really. You know what I'm saying? Because it's a news liquidation. This is just happened during news liquidating. Right? This closed up here. So market structure shift, right? So you got liquidation. So it is liquidation. This is the real structure. It's just liquidation. Stop loss. Oh, I had to go to the. I'm not gonna do all that. I'm sorry. But I put my stop loss here for another reason. There's a wick down here. There's a wick. This is the last wick before this liquidation. Right? So I put my stop loss here. Now, what I'm trying to get you guys to focus on is where price is gonna go. What did price do? did what I was just talking about. See this protect, protected. Take out this low, protected. It's taken out. Gets liquidated. Doesn't get taken out. Gets liquidated. Break structure. We're continuing bearish. We're still bearish. And then what happens? Break a structure here bullishly, signifying that pricing will come up and do what? After, since these are no longer protected, since this high is no longer protected because it just got taken out, we know that we're gonna now target the protected highs. This is protected, this is protected, this is protected. This is all part of the same trend. These are relatively equal highs, meaning they're not exactly the same, but they're basically around the same high. You see what I'm saying? Price came, took both of those out. That was a great area to target. Now what happened here? It took out this high as well. You know why? Because it's also part of this trend. Now, does it always do this? It doesn't always take out this high. It doesn't always take out the very first high, okay? Which is why you want to be wary and you want to know why, if it makes sense to target that area. See, it did make sense to target this area because we've already liquidated everything down here, so I should have put my target higher. We all made mistakes. I should have put my target higher, could have got more money, but I didn't do that. I played it safe and I took these highs because these are very, you stood out to me. They're like right there. You know what I'm saying? It's like, yo, it's very obvious. You want to make trading as clear and obvious as possible. This is very obvious. So I was like, why would I do all that? And I could just target this. That's exactly what I did. Targeted these. Price ended up coming up, taking out these relative equals highs, which I didn't see. And yeah, the rest is history. See, that happens. That's what you target. Look, relative equal lows. These are the, I think these had the same price. 35, 34. So this is 35, this is 34. It's off by a literal pip. A pipette. And not even a pip, a pipette, which is what we don't count. But to the pip, these are the same lows. Took these out, but price came all the way down just to make sure it took out this little area right here. Just because they want to. What happened? Boom. After that, price took off for the rest of the week. For the rest of the week, price was up after taking this little area. You know why? Because it had all this liquidity left here. And that's just a basic example of how that works. Did I talk about everything? Talk about liquidity, how to find it. Oh, also how to find liquidity. When you trade sessions, right? Because I have my chart delineated in sessions. This is the New York session. The New York session starts at 7, but I don't really start trading until 8:30. I trade from 8:30 to 11. When the session's from 7 to 11, but I trade from 8:30 to 11. That's when the news lifts and enters the market. You also want to pay attention to session liquidity, which is what I was talking about in my AUD video of why I wait for things to get wait for a liquidation and then prices reverse. Right? As you see here, what happened? So during the session, price took out. So all of this that was made during London session, because this is one session right here. The session stops at 5. So from there to the left to this blue line, that's London session. London session was completely swept bullishly here. Sweep of buy side. So you got a sweep, which is cool, which is what I wanted. You got a sweep, so then what? Now we're looking for a bearish breaker structure so that we can take out the sell side liquidity. So we took out the buy side liquidity for the session. Now we're looking to take out the sell side liquidity. Like I said, every day may not be a reversal. But on reversal days, you're going to know because of these, what I just listed. You'll know when it's a reversal day. Because some days, it'll just be some sessions and some days, one day makes the higher the lower of the day. And you'll just have a continuation. In this instance, we had, you know what I'm saying? The days that you don't have a reversal, you have a continuation. Or you just have consolidation. For example, here, up, just consolidate the rest of the day. Like this. The low of the day, we had a classic buy day. Just went up the whole day. And then we just consolidate at the end of the day. Same here. Like Some days we won't have a reversal. Some days, because more continuations happen as well. If we're looking to reach a certain target by the end of the week, we're going to only have continuations. See here, we had a reversal. We took out all this bullish. We took out all of this structure bullishly from the London session. So we took out the London session liquidity. And we came back down and took out the London session sell side liquidity. So liquidity rests above and below sessions. It rests above and below relatively equal highs and equal lows, and it rests also along trend lines. For example, this is why you don't see a lot of smart money trader or any smart money trader use trend line. They get liquidated. Because look, the trend line we're bullish. We're still bullish. But what happened? We had all these lows right here. All these lows in here just got liquidated. So we're only strictly focused on the line. We got a bounce right here. We're like, okay, bet. We got this bounce. Now we're looking to take out something. You look back in time. We're gonna take out something up here. There's nothing really out there, nothing to take out. But based on a trend line, how retail trades, this makes sense to target something. They'll probably target 1 or 2, 1 or 3 or something. You know what I'm saying? But there's none up there to target liquidity wise. So why would we go up here? You know what I'm saying? So what happens? Instead of going up there, because there's no targets and there's nothing to liquidate, because we're already up here, and all we're doing is we're in the midst of making these highs, these equal highs. Come back down, grab some more fuel, we refuel, gas station, you know what I'm saying? Come back down, take out a few lows. Okay, great. So look, we had a trend line break. This is how retail sees it. Like, oh my God, okay, trend line break. So we're gonna come back up, bounce, boom. And price continues up. Which retail got wrong because they're looking at this trend line. Okay, you have trend line liquidity like this. So they're going down, they put their sell here. They're gonna target the bottom because they target the bottom of the trend line. Because I used to trade retail, so I know. Retail trade. I used to trade retail. Like this. Hold on. What am I doing? Use Fibonacci. They be looking like this, which looks like a good trade retail wise. Look at this. Retail wise, that's wonderful. So boom. Trend line break. Come down. 50%. Boom. Doesn't work that way. It doesn't work that way because there's nothing. Because we're in an uptrend, first off, and we're just looking for a reason to continue bullish. We have that reason now. We came down, took out some lows, built some fuel. Now you have a little distance to come back up and take out these equal highs. Now we can take this little buy, which is why it does this and it peaks here. Now it's taken out, it's done what that move needed to do, it did. Now the rest of this has its own purposes. Probably on a daily chart, monthly chart, weekly chart. We don't know, right? So we're not really looking into that right now. But every move in the market has a purpose. For example, up, up. This move, this whole news event and move came to liquidate the equal lows of the Asian and the London session. See these equal lows? This whole move was orchestrated to take this out. And then what? It just went up like nothing happened. And then what? Came over here. This little move came and took this out. Came down. We consolidated the whole day. And the price just dropped. You know why this happened? This happened to come take out this liquidity on a bigger scale. It came to take all that out. All that it didn't get out. Look, what are these? These are now relatively equal lows. Came to take out those relatively equal lows. And then, this is basic market strategy. Continue down. Take out sell side. Back up. Took out a little bit of buy side. We're still bearish though. We're still bearish on a higher time frame. We're bearish. So what? People think we're bullish now. So they're looking for buys. No, we're not. We're not bullish. All we did was just liquidate. liquidations. Boom. Came right down, took it all out. And that's why you have to use multiple time frames in your analysis. Because we go to other time frames, we'll see that there was nothing more than liquidation. Probably not this time frame. Before, see, there was nothing more than liquidation. See, candles are below, wicks liquidated, boom, continue down. See what I'm saying? So that's basically an introduction to liquidity. Last thing I want to touch on about liquidity before I go is interior and exterior liquidity, which I think we kind of talked about. We kind of touched on it, but I just didn't give you a name for it. Interior and exterior liquidity. So that's this. Here, right? It's kind of ugly. All right, bet. That liquidity right there. I'll make this a different color. Gonna make this blue because I love blue. Right? All right, cool. So we have exterior liquidity and we have interior liquidity. Interior liquidity is the liquidity that's like this. So say for instance, we know we're bullish. Make a high highs, high lows, high highs, high lows, right? The liquidity that's getting taken out in here is internal liquidity, meaning we could be a seller to take out some of these lower time frame protect the highs and lows, but we don't want to take out the big time frames, the big time frame moves yet. You know what I'm saying? Like this area is protected still because we're overall on a bigger scale. I saw in my other video, market structure. We're overall bullish. All we're doing is being bearish from a certain point in order to get back in line with the higher time frame bias. So up, we're bearish here. So what? We're taking out took this low out, took out that low, and that's what I'm saying. Price may not come all the way down here and take this out because it doesn't make sense for it to just do that. It has to have a reason to. There's no reason to if we're bullish. So price isn't gonna come all the way down here. What I tell you guys about that? You wanna just look at price, make sure it's in discount. Ooh, I wrote that through that wrong. You wanna make sure it's in a discount, which it is here. And what? Now we see that. Oh, okay, we're bullish. We're bullish again. Took out the exterior and interior, meaning we're bullish. So look, we took. So depending on the trend direction, that's the type of liquidity that we're taking out. So we're taking out exterior, exterior. Now, if we were to switch to bearish, this is how you know on a bigger time frame when we really have a big shift in structure on a higher time frame because this protected low just got taken out by this. So now what? This is a protected high, and so oh my bad. All right, I'm back. So this is a protected high, and these lows are no longer protected, meaning what? They're now targets. So we target this one. We ended up taking out both of these, but there'll be more along the way. I didn't draw this to scale. My bad. You know what I'm saying? But you kind of get the gist. So we took out this one. So then what? We took out this one. So then what? Now we expected to take out this one. So up, down. Mm-hmm. Takes out some interior. Why? To refuel, like I was talking about earlier. To refuel. Then what? Continues bearishly down. Takes out this one. And then it's gonna start taking out all the other previously protected highs and lows. And that's kind of how it works. Let me see if I can put this on a bigger chart for you guys real quick. And this will be the last thing before I go. So go back to the daily. Alrighty. It's the most recent one, so we're gonna use this one. See? Now look. So, yeah. So now from this point, we've pretty much been bearish, right? Liquidation. This is a steep little push up and it can't be right now. So this is a protected high that is no longer protected because look, we just took it out. So now what? This is now a protect. This should be a protected low, meaning price should continue to take this out. So now that this is protected, this is exterior liquidity, meaning we're not even going to look to touch that right now because we look like we're in a bullish. We have a bullish bias in play. So we know that we're going to be bearish. So what? So it's bearish to become bullish until a certain point, which usually is the 50%. Short was in the week, was usually around 50%. So what? We're taking out all these premium protected highs. So we're taking all these out. Probably gonna end up taking out this one, and then we could reverse from here. There's a possible point to reverse from. We could reverse from this fair value gap, this big gap in price here. That'd be cool. That's a possibility too. You never know. You know what I'm saying? But the point is that this is interior liquidity. I was telling you guys about that trend line. This is interior liquidity. This is trend line liquidity. See? Trend line liquidity. Look, it stayed on the trend line and then it broke it. Trend line liquidity. People that's riding this trend line, you just got taken out. As well as the people, you know what I'm saying, that are just buying. Because we've been going up for a while. So they're just buying. We get taken out. But they have their stop loss under these lows. They get taken out. So that's pretty much what's happening here. We're coming back down. And we're seeking and destroying all these people in here. Taking all of them out. In order to gain fuel and momentum to continue. So exterior liquidity rests at the protected highs and lows of exterior liquidity. On the outside, on the higher time frames, right? On the lower time frames, it's the same principle. Everything I just talked about is the same principle on the higher and lower time frames. That's exactly what's going on here. We have bearishness now, so now we're taking out all of the previously protected lows. Until we take out a previously protected high, we are not bullish. We are bearish until we take out previously protected high. So if we were to come back up, take this high out, okay, cool. We might be bullish. We may be just bullish early because we didn't come all the way down. We may just be bullish early. You never know, right? But until we take out a previously, until we take out a protected high, we are bearish, and that's kind of how you read liquidity. That's how you find liquidity, and that's kind of how you just use liquidity in trades. So I try to give you guys an example of everything. Make sure you study this video. Please leave a like. Don't